Let's take some time to talk about risk, reward, and win rate, and why you need to understand these concepts to be a great trader. Understand what risk is. Risk is how much you're willing to lose if a trade goes against you. For example, if you buy a stock at $100 and you want to set a stop loss at $95, you're risking $5 per share on that trade. You're not risking the entire $100 because you have set a stop loss before you took the trade, telling yourself that the most that you're going to lose out of this $100 is only $5. So let's talk about what is reward. Reward is the profit target on the trade. So example, if your profit target is $110, your reward is $10. In this scenario, we risk $5 to make $10. This gives us a risk-reward ratio of 1 to 2. Risk-reward ratios is basically the reward divided by the risk. Good traders tend to aim for at least a 1 to 2 or 1 to 3 ratio. This allows you to take more trades but still be profitable. This means that if we are going to risk $5, we want to target $10 if we're doing a 1 to 2 risk-reward. If we're doing a 1 to 3 risk-reward, if we risk that same $5, we want to target $15. This keeps us in the game longer and helps us especially when we combine a win rate. So a win rate is the percentage of trades that you are going to have as winners versus losers. Example, if you take 60 out of 100 trades and you win those 60 trades, you're going to have a win rate of 60%. The other 40% are going to be losers. But here is the magic. We want to combine both concepts because if we focus on high quality trades and we wait until our risk reward is at least 1.5 or higher, meaning if we risk $10, we're trying to make $15, then that's when we strike. Because we have a risk reward above 1, that means that our win rate only has to be 40% to profit in the long term. So imagine that you're flipping a coin 100 times. And if you win $1.50 every time you're right, and you lose $1 every time you're wrong, you will profit in the long run. But the trick is to keep the risk consistent. Set a defined allocated amount of money that you're willing to risk for all of your trades until you've decided it's time to scale up on all of your trades. Whether it's $10, $100, $500, it's up to you. It's whatever capital and firepower you have to take trades that allows you to define how much you're willing to risk per trade. Because remember, it's about the total number of trades that you take. Our goal is to focus on good risk reward and a solid win rate. Let's visualize a good risk reward ratio when we're taking a trade. This chart in NVIDIA has a downtrend here, 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 and here. We notice that we have a breakout point right here. So in real time, we would say, let's look at taking a trade. We would set a stop loss just below the previous low, which is here at 86.87. So we want to target at least 1.5 this distance. So if we are in at $111.61, we want to target around $148 to the upside. It also correlates with a previous high here, here, and here. So we have our bottom, we have our target, we have our breakout signal. And if you take the trade, as you notice over time, NVIDIA eventually does hit that 148 target. This is a high quality trade that you could take by understanding proper risk reward ratios and win rate probability. Now, let's look at Meta for another example. Meta has established a trend here, here, and here. So this trend line is valid, so we should be bullish. We have a resistance line here, which is this purple line. As you can see, we found resistance here, here, a tiny bit of support that fell through, and more resistance here, and it finally broke through, so this is a test of support. So we would want to look at a buying opportunity because our old resistance line, which is our new support line, correlates with our trend line. So we'd look for a buy opportunity at 512. We'd set a stop loss just below the previous high, which is right, or the previous higher low, which is right here at $492. So the difference between $512 and $492 is roughly $21. So we want to target at least $30 to $42 to the upside. So let's target around 550, which is represented by this green line, and see how the trade plays out. As you can see, it was an immediate stop out a few days later, but let's look at the math to show you how you still profited in the end of this. Let's look at the results. For trade 1, NVIDIA, we entered at $111, our target was $150, our stop was $87, and our max loss that we were willing to risk was $250. The shares needed was 10 shares for this trade. It was just above 10 shares that was needed for the full 250, but we rounded down to keep the math simple. And as a result, we made $390. Notice that our result was higher than our max loss. That gives us room for margin for whenever we actually have a loss, such as trade 2 with Meta, where we entered at 512, our target was 550, our stop was 490. We still risked $250 if we were going to be wrong. We needed 11 shares for this trade to happen, which was really 11.3 shares, but again, we round down to keep the math simple. As a result, we had a loss of $242. But if you combine both of these trades together, you see that we had a net profit of $148. This gives us a win rate of 50%, and we made a profit. Here at T-Signal, we shoot for a higher win rate because we look for high quality trades with a great risk reward setup. I hope you enjoyed the video. If you did, why don't you unlock your trading potential and join us at T-Signal, where we're going to give you everything you need to succeed, such as premium Discord access, high quality trade alerts, multiple weekly alerts, monthly performance recaps, and educational videos, and so much more. At T-Signal, our goal is to help you become a better trader.